buy these five assets monthly for passive income in Nigeria and never work again. In this video, I'm going to show you the five assets to invest in for regular passive income if you want to retire early. Many of us have been wondering how we can actually generate passive income without having to put in recurring physical work. So in this video, I researched certain assets that I think if you continually buy them every month, consistently, it's just a matter of time, depending on what you are putting in, you would most likely be on your way to generating passive income every time. Now, what does this mean? Now, in this video, I took my time. In short, there are so many passive income assets. When you go online today to search passive income ideas, passive income assets, you will find so many contents. In short, there are videos that will even tell you 20, 30, 40 passive income assets. But here, I had to take my time, research, drill down to my top five. Now, this top five was selected based on the fact that you do not need to work. That means once you put your money in there, it rolls. Once you put your money in there, it rolls. So I have to screen them based on physical activity. That means I do not want a passive income that still requires my time. I do not want a passive income that still requires me to do some work. So that is why I had to say, tag this video, buy these passive income assets and never work again. Now, it doesn't mean that you naturally stop working. If you want to keep working, if you want to continue working, definitely you need to work to make money, right? But this passive income are not dependent on your work. That means you don't need to do anything for the flows to come in. So that's why I had to target buy these five assets monthly. Now, the monthly there, it means you have to continually invest in these assets as the cash are coming in, either from your salary or from the profit you have generated so far. You can continue to build this asset consistently. And in just a matter of time, you're actually on your way to generating passive income all year round. So here is a disclaimer before I continue. Now, the ideas shared in this video are based on my personal research and calculation, meaning I've done my research, I've done my calculations, and then I feel that this five assets ranks at the top as far as I'm concerned. Now, you need to also put in a lot of discipline. Yes, a lot of discipline and consistency, meaning that it's not something you will do today, this month, and say, no, I want to rest. That means you have to set an investment plan. You have to set a savings plan that every month, as cash is coming in, you are building this asset. You are investing, you are investing, you are investing, you are investing, you are investing until you get to that point where your passive income is able to pay your bills. And then what you earn depends on your capital. So return may vary. So don't think that you're going to earn the same return as the other person. So whatever you're going to earn depends on how much you have invested. So if you want to be a lot more aggressive in your investment, so it means that you want to probably push yourself towards attaining that status. Now, if you want to be a little bit conservative, maybe gradually, like I said, your return depends on you. So for someone who is going to be investing an average of like, let's say 1 million every 3 months or every 6 months, you can't expect the person to get the same return as the other person that is probably putting in 50K 30K, 40K. But then it's not about the money, but how consistent you are in it. That is actually what matters. So there's no minimum, but then you have to be consistent. And also, if you're also part of a community, I think the vibes, I think the encouragement, the fact that you're seeing others do it would also help you push more. So the final one is kindly vet my recommendation based on your risk profile. So if I share these five assets, you need to check each of my recommendation based on your risk profile. Do you understand? So you need to be sure that they align with your risk profile. But I've tried at my best to ensure that each of these assets are low risk if you do the right thing. They are not high risk. They are low risk assets that you are so sure of generating passive income from year on year. In short, there are some that are passive income, or the cash flow comes in every three months, and I'll talk about that later. So let's move on to the next slide. Now, what are passive income? Let's look at it again. Many of us have heard it multiple times. It's not a strange word, but then let me just break it down um, and then tie to this particular video. Now, passive income, these are income that doesn't depend on your active participation in productive activities. That means you don't have to participate for the income to come in. But if it's an income that requires your active participation, it's called an active income. So there is a word called active income. There is also another word called passive income. Now, active income requires you to participate, meaning if you don't go out to work, if you don't go out to run your business, if you don't go out to train your clients, if you don't go out to sell, if you don't go out to talk, you will not make money. So that's active income. It requires your active participation. Now, there is a passive income. That one does not require you to participate. That one, from the word passive, it means it comes in consistently. It comes in every now and then. It's recurring. So even if you decide to sleep today, it still does not stop this money from flowing in. That's why it's called passive income. And then from my own check, I think that the moment your passive income actually outnumbers your active income, that's where you have actually attained financial freedom. Because if you don't work and you decide to sit back at home and your investment are paying your bills, then that's where you attain. But if your active income is far more than your passive income, then there's still a lot of work for us to do. So what that means is that you need to check yourself and ask yourself, am I making more passive income compared to active income, or am I making more active income compared to my passive income? So this is a question you have to answer yourself. So look at your earnings, look at your inflow, ask yourself what portion of this money is a passive income and what portion of your money is active income. So a lot of us actually have more active income than passive income. And then we think that we are rich, we think we're wealthy. That's not it. Because if your active income is far more than your passive income, you've only attained financial security and not financial freedom. Because if anything happens, that's all. You have to start from zero again. But if your passive income is more than your active income, you attain financial freedom. So if anything happens, you can still continue and then not being affected. Now, the second one is passive income is tied to owning an asset. So passive income is tied to owning an asset. The reason you don't have to work is because you own an asset. So the asset is doing the job for you. The asset is what is doing the whole lot of work while you are here sitting. So your focus is to see how you can own an asset rather than looking to work to make more money. You're looking to work to generate money to buy an asset so that the asset can also contribute in generating more flows for you. Now, they are regular cash flow that has no end. That is, I like this part. I like this part. Passive income are regular cash flow. That means the flow is infinite. Like you can't set, it doesn't have an expiration date. You can't say, oh, on this day this money is going to stop coming in. Why? Because you own assets, you own stable assets, you own assets that over time has been proven to continually generate cash flow for you. Now, the final one, which is extremely important, is if your passive income doesn't provide perfect hedge against rising inflation, then it's a problem. Many of us own assets, fine, and the asset generates income, fine. But then when you look at the income the asset is generating, it might look good today, it might look attractive, might look nice, but over time, if you do not factor in inflation into that passive income, now that passive income, the value of that passive income might be wiped out completely. An example, let's assume that you own a property here in Nigeria, and then on a monthly basis, you generate an average of 1.2 million or 3 million on that property. Now, if you consider the state of the economy, inflation already high at 30%, the cost of uh, things in the market, prices are already going up. Now, if you look at the nominal value of that rent, it's 1 million, 2 million, 30 million, whatever it is, which is fine. But if you look at the value of that rent, which is the real value, what that rent can buy, what that rental income can buy for you. Now, if you keep that money the way it is, you will notice that the purchasing value of that money is being wiped out, because what 1 million naira could buy 10 years ago, 5 years ago, today it can no longer buy. Why? Because of inflation. So that means that your passive income is being eroded gradually. Now, if you don't hedge against that part, if you don't hedge against it, your passive income might eventually not give you the real value. It's just a matter of time. Your money has no value again. So even though the money is still flowing in, but you realize that it's not providing the same value as it was 10 or 15 years back. So that's why a good passive income has to provide hedge against rising inflation. So this is extremely important. No, many of us talk about any passive income, but we do not consider the fact that a good passive income has to also, meaning if the price of things are going up, you also have a way of hedging against that, hedging against that rising price. And I'll show you how to do that in this video course. Now, if this is the first time, if you're getting value, this um, slide makes sense to you, kindly hit the subscription button if it's your first time, turn on the notification bell so that when I release more videos like this, you will be notified and also be able to see my ideas or follow my ideas and recommendations. Now, let's move to the next slide. Now, what you should know about this passive income asset. Now, the passive income asset I'm about to share with you, look at the things that makes them different. So this is not your regular passive income recommendation that you see online. This is a research recommendation. These are recommendations that would continually keep you flow that will make you stay afloat. And then you will see why this recommendation is totally different from others. The first one is owning all means you have a stable portfolio. Now, if you're in my community recently, I started talking about owning a stable portfolio. In short, there are three types of portfolio you should have. The first one is a stable portfolio. The second one is an aggressive portfolio. And the third one is cash. Now, a stable portfolio is designed to provide cash flow for you, meaning these ones, you buy them for cash flow. You don't buy them for capital gain. Now, even though they can give you long-term capital gain, maybe in the next 5 to 10 years, but the reasons why you're building this portfolio is for cash flow. And one good thing about stable portfolio is that they help you weather the storm, meaning when the market is down, when the market is going through volatility, it still doesn't stop the cash from flowing. That's why it's called a stable portfolio. It enjoys some level of stability. So when you own all these five passive income assets that I want to share with you, it means you have actually built a stable portfolio. So if you checkmate your investment and you see that all this, one of them is missing, then you might probably need to add. So don't think that one is fine, two is fine. You must own all of them for you to say, yes, I have a stable portfolio. Now, if you look at the second one, it's a balanced portfolio. Now, owning a stable portfolio is another thing, and owning a balanced stable portfolio is another thing. There are stable portfolios that are not balanced. Yes, it might be stable today, but if anything happens, before you know it, you might just lose it all. Now, when I say lose it all, it doesn't mean the portfolio itself will go down, but the cash flow from it will be affected. You know, the excess of stable portfolio is to generate cash flow. So if it's not balanced, that means your cash flow might be affected. Not like the cash flow will be affected in terms of maybe um, the amount, but then the value it provides. So here, the balanced portfolio protects you from currency risk. What's currency risk? Currency risk are risks that arises as a result of exchange rate fluctuations. That's simple. You know, the initial example I shared earlier on, how that a passive income must provide a perfect hedge against rising inflation. So this is currency risk. So if your passive income is exposed to currency risk, then you might be affected by inflation. So one of the things you can do is to find a way to build a portfolio that protects you from currency risk, meaning that if exchange rate is going up and down, you know that over time, one of your portfolio is helping you to stay afloat. So if you build a balanced portfolio, it means that it has a combination of local and foreign assets. So building a balanced portfolio is not one that requires you to concentrate on Naira. If all your stable portfolio is in Naira, you are at risk. You are at risk. And what's that risk? Currency risk. And currency risk would not protect you. So this is the effect of currency risk. It's just a matter of time. The cash flow in Naira will be affected. Why? Because the value it provides may not be the same year on year. So watch out for that keyword, balanced portfolio. And a balanced portfolio is one that has a combination of local and foreign assets, meaning your stable portfolio must make up of local and foreign assets. Local assets gives you your cash flow in naira. Foreign assets provides your cash flow in dollar. So that way you have a balanced portfolio. Now, the third one, the cash flow will help you stay ahead of inflation. That's the good part. So if you're earning foreign currency income, you're earning local currency income, put them together, it will help you stay afloat. In short, you can even leverage on the foreign currency inflow to be able to earn more because of higher rates in the future. So, I mean, as prices are going up, your exchange rate conversion is also going up. They also offer long-term capital appreciation and less volatile. Now, if you hold your stable portfolio for a long time, like minimum of 3 years, 5 years, 10 years, you would see that the value of your portfolio will also go on along that side. Let me share the two reasons. First one is that the asset you own has the potential of increasing in value. That's number one, because you're holding it for a long time. It's been proven that long-term investments, tends to provide steady capital appreciation. Now, when you hold an asset for a long time, the chance that the asset will appreciate is also high. But when you hold the asset on a short term, the chance that it will appreciate is very low. Now, that also depends on the due diligence you carry out. If you look at a lot of stocks, look at the market over the long run, look at the Nigerian stock market in the long term, look at the US stock market in the long term, you see that despite the fluctuations and all that, the market is still high. So that's to tell you what long-term investment does for you. It gives you that opportunity to enjoy capital appreciation in the long run, meaning that irrespective of the volatility in the market, everybody everybody tends to patronize the companies. I can share reasons why the stock market will continue to appreciate till tomorrow. Because number one, stock market is made up of businesses. And you know what? These are the businesses that provide employment. So if these businesses go down, then everybody's out of job. So the government can never allow businesses to collapse because of employment. So in the long run, the stock market will always go up. Just look at US Fed. So government will always support businesses. Now leave CBN. CBN is doing what it's doing because according to CBN, they want to stabilize the currency. But if you look at it critically, there's now more like a back end push that SMEs are suffering, do something about it. So big government would always support and ensure that businesses stay afloat. That's a good thing. Number two reasons why you would enjoy long-term capital appreciation is, in short, this one gives you a high level of stability when you reinvest your cash flow. You know, it's been proven over time that reinvesting your cash flow or reinvesting your dividend is the best way to enjoy capital appreciation. In one of my video courses on dividend to income costs, if you go to coachoge.com, I have a course called dividend to income cost. Now, in that course, I discuss the power of reinvesting your dividend. This is it here. I discuss the power of reinvesting your dividend. How that even if your stock prices, even if the asset you're buying, this company you're buying their shares, even if their share price dips by 30, 40, 50%, for the fact that you are investing your dividend alone will still provide long-term capital appreciation. Why? Because by acquiring more of their shares at zero cost, you are reducing your average costs because the number of units you own will increase while the cost is still stable. Now, as you continually acquire more shares of the company, the average cost is coming down. Now, it will get to a point where you would most likely break even and turn profit immediately, even though the share price is going down. Because the more of that company's share price you buy at a lower price, the more units you get. And the more units you get, the lower your average cost. So over time, you will enjoy long-term capital appreciation. That is one of the major advantage of owning a stable portfolio. Why? Because by reinvesting your cash flow, you reduce your average cost. And by reducing your average cost, you push yourself into profit faster. Now, the final thing you should know about passive income assets is that they make you liquid because of regular cash flow. This is very important. Now, why do we call it passive income if it doesn't make you liquid? Meaning they have to make it liquid regularly. It's key. If it's not making you liquid regularly, yes, it might still be passive income. But then for me, I wouldn't really classify it as a liquid passive income. There are passive income that you would have to wait till the end of the year before they come in, which is fine. There are passive income that comes in regularly. Regularly means some can come in on a monthly basis, some can come in every three months, some can come in every 6 months. But the idea is throughout the course of the year, there are inflows in between. There are inflows in between. And good thing is, as those inflows are coming in between, you can also reinvest them. And when you reinvest them, you also push yourself towards capital appreciation faster. So I hope you now got to the point. So this is the type of asset I want to recommend. So I don't want to recommend general assets that people will talk about. I want to recommend a balanced portfolio that would help you generate regular passive income. Let's move to the first one. The first one is a local asset. Now, treasury bills, federal government savings bonds. Now, this one is very important. This one is designed to provide regular cash flow for you. Now, you own this asset by lending to the government. Now, what does lending to the government means? At every point in time, when the government wants to execute certain projects, when government needs money to finance short-term needs, or when government wants to probably take money out of circulation, they sell you an instrument. So that instrument is either treasury bill or bond. Now, if it's within a year, then that's where treasury bill comes in. So treasury bill maturity, CBN treasury bills maturity ranges from 91 to 365 days. So if government needs short-term cash, like, oh, let's quickly finance short-term expenses, short-term needs, they use CBN to generate that. So, and the ranges from 91 to 365 days. That means you can actually lend your money to the government for 91 days, for 270 days, and also 365 days. The maximum maturity period is 1 year. After a year, you get your capital. Now, why the FGM bond ranges from 2 years to 30 years. Now, bond is long term. Now, one of the main utilization of bonds is for infrastructural projects, like the ongoing Lagos Calabar Coastal Road. Now, if federal government needs money, they're going to sell bonds to you. So when they sell bonds to you, whatever they raise, that's what they use to fund infrastructural projects. So that bond generates a return too. Now, interest return on T-bill is paid upfront. Now, when you invest in treasury bill, they pay your interest upfront, meaning you collect your interest today, and then at the end of maturity period, you collect your capital. Now, that's the passive income we're talking about, something that provides regular cash flow for you. Now, why the bond interest is paid semi-annually twice a year. So I like this part because by providing regular cash flow, either via upfront payments or every 6 months, you are liquid to fund expenses. Now, for me, I always advise that you also find a way to reinvest your interest. So you can invest your interest in other opportunities to also make more money from it. So you don't have to eat the interest. You don't have to spend it. It's a seed. So when the interest is coming in, reinvest it, use it to grow, use it to leverage on the power of compound interest to grow your wealth, to grow your stable portfolio. Now, FGM bond yield and treasury bill yield are currently hovering around 18 to 90% level right now, and it's quite high. This is quite attractive and juicy compared to the stock market. So at this rate of 18 to 90%, it's a no-brainer that everyone should be investing in this treasury bill and savings bond right now. Imagine collecting 18 to 90% of your capital upfront. So that's good. Now, a lot of people are also having issues calculating their return or their interest on treasury bill and bond. This is how it's calculated. Now, this is how you calculate your interest return. Your amount invested, look at it here, the amount you have invested multiplied by the interest rate. The interest rate varies. Now, for 91 days, it could be 16%. For 270 days, it could be 17. 360 could be 18 or 19. So whatever interest you're earning at that point, that's the interest right here. So the interest multiplied by the amount you have invested. Most people, their own calculation is whatever interest you're being paid will be interest multiplied by the amount that you invested. No, it doesn't work that way. So, except you are investing in 1 year. So, if you're investing in a lesser maturity period, like 91 or 70 days, you do the amount you're investing multiplied by the interest times now duration divided by 365 days. So, if you're investing for 90 days, that will now be 91, sorry, to be 91 divided by 365 days. Whatever amount you get, that will then be multiplied to this interest. So let's assume that you are investing 10M. So and you're collecting like 16% for 91 days. 16% for 91 days. So you do 91 divided by 365 days. That will give you 0.24. Can you see here? 16% for 91 days. So that's why we got 91 divided by 365, 0.24. So it will be 0.24 multiplied by 16% is 0.16 times how much are you investing? So let's say you're investing 10, 1. So you can see here. So that means your interest is 384. This is your gross. This is the gross return. This is the gross interest. Now, they are going to factor in VAT. They're going to factor in necessary charges, withholding tax. So it is the net of it that will then give you your net return. So this calculation here will just tell you your gross return, but most likely lesser when they factor in the VAT. So that's the first one, which is the CBN Treasury and also the government bond. Now, the next local stable portfolio you can look at is commercial papers. Commercial papers. Now, I like commercial papers because the return are actually higher than that of treasury bill. Even though treasury bill, commercial paper, or any other fixed income market, they are driven by CBN monetary policy rates. But then commercial paper tends to be a lot more higher. Why is it higher? Because the risk is also high. It's simple. They won't tell you that. CBN treasury bill and FGS bond, the risk is lower, almost near zero. But commercial paper, the risk is high. Why is it high? The answer is simple. You're investing in companies. You're lending money to your companies, to companies. What if the company collapse? What if something happens? Government can always print money. So that's why the return on CP is a lot higher. Now, CP is issued by high rated. Now, note this part, high rated companies. So that is where the default rate is very, very low. CP is issued by high rated companies to fund their short-term obligations or working capital needs. The return on CP is quite attractive and juicy compared to Treasury bill and FJM bond. I've already explained that. So if a company needs money, they need money to finance short-term obligation or working capital needs. Working capital needs basically covers paying salaries, paying vendors, just to run normal operations and all that. So if a company needs a huge amount of cash to cover up such expenses in that certain period now, and a lot of times, most of their money is actually tied to either their receivables. So they only want to use that to quickly pay up, or maybe they have another alternative way of generating that money, or from that calculation, by the time your commercial paper expires, they would have liquidated a lot of invoices. So that is where CP comes in. So when you want to invest in CP, I always advise that you know why the company wants to raise that money, because not every CP are viable. Some companies might be paying Peter to pay Paul. So this update, commercial paper interest of VFT group, that's is around 24%. You can see 24% compared to 18-19% of commercial paper is quite high. Other notable issuers are Dangote Sugar Refinery, 23%. And then for you to invest in commercial paper, you need a minimum of 5M. Now, please make sure that you only buy CP of companies with stable outlook and low debt. It's key. Now, if a company is always coming to the market to issue commercial paper, and when you look at their book, they are only issuing commercial paper to settle another creditors, is a problem. So make sure a company is not robbing Peter to pay Paul. So what I do sometimes is I look at the book of that company and I make sure that it has low debt. So there are two things I watch out for. Number one, I look at the debt to equity ratio of that company. If the company is too exposed to debt beyond my limits. And number two, most important, is I want to be sure that the company has an interest coverage ratio above 2, meaning that the earnings they are generating from operation, basically earnings before interest and tax, is actually more than their expenses. So if you're looking through a company's book, you want to be sure that the company has a low debt to equity. So let me look for a company um, to demonstrate this part. So Dangote Sugar Refinery, 23%. So let's use Dangote Sugar for this analysis. So I'm going to Nigerian Stock Exchange website. I want to download Dangote Sugar financial statements. So always look at the company financial statement before you jump on every TP. Yes, I like the fact that a lot of stockbrokers, financial analysts, advisors, in short, they might have done the homework for you because most of them would not want their clients to buy into a commercial paper that has tendency to default. Kudos to them. I have not seen anything like that before. But then it's also good for you to do your due diligence and ensure that you stay safe or you buy into stable portfolio. So here is Dangote Sugar Refinery financial statements. Yes. So I'd like to look at a financial statement. So first thing I want to check is let's look at our debt to equity right here. This is the total debt. So total equity here is around total equity is 10.25. This is it here. 10.25. And total liability is 607. This is it here. Total liability is 607 here, and total equity is 10.5. 607, that means debt to equity is above 1. So if you do 607.5 divided by 10.2, 607.5 divided by 10.2, this is almost 59. 59, debt to equity of 59. What does that mean? It means Dangote Sugar is largely exposed to debt. Dangote Sugar is largely exposed to debt. Look at it. Look at total assets, 617 here. So this, now look at their debt to assets. Debt to assets, 607 divided by 617. Debt to asset is almost 98%. Look at it here. Total liability 607, total debt is 617. So 98%, 0.98. This is quite high. This is quite high. Debt to asset is quite high. But then, is it a problem? Not yet. Not yet. I want to look at their earnings before interest and tax. If they are earning enough to cover up interest expenses. So, what is earnings before interest and tax? Here, this is operating. This is here, operating income. Let's look at for the whole of 2023. Yeah, for the group. Yes, financial year 2023. Operating income is 72. Yes, this is it here. Operating income is 72, 72.6. This is it here. Financial year 72.6. Now, what is the interest expenses? See, finance costs. Look at finance cost 201. Can you see here? Finance cost is 201. Finance cost is 201. I don't know if I'm wrong in this analysis. Net finance cost is 191. Now, this is finance cost here. So let's look at note 10. Note 10. Note 10. This is Dangote Sugar Refinery. Note 10. Note 10. Note 10. Let's look at note 10. Okay, here, this is a makeup of finance cost. Now, from this, what is their interest? Now, can you see interest on commercial paper? Can you see right here? The same commercial paper that we just talked about. Can you see the interest on commercial paper? Issue cost. You can see here interest on bank loan, interest on lease expenses, finance cost, exchange rate loss. So you can see what is happening right now. You can see that Dangote Sugar is carrying a lot of interest expenses, and commercial paper is one of them. So you are not the only creditor. There are so many creditors that are tied to Dangote Sugar. So if I come here and I check, look at the group financial year, they are carrying a finance cost of it's here. This is it here. That's 8 billion, I guess so. Yes, 8 billion. Finance cost of 8 billion. And then this is the finance income of 2.5. 8 billion finance costs. So let's go back to, you can see, this is the commercial paper that you want to invest in. Can you see here? So they already have an existing 543. Remember, you are not the only creditor, the only creditor. Because right now you're borrowing them money. That's what it means. So let's go back to the income statements. Let's go back to the income statements. So here, finance cost. I think the finance cost we analyzed is the Q1 results of the company. Is the Q1 result, not the end of the year. So maybe I have to go back to Dangote. Let me check the audited reports for 2023. Yes, I think this would be fine for me to look at so I can get the figures right. But then what I'm saying is not impressive. Must be very sincere. What I am saying is not impressive at all. So look at total debt here. Look at the total debt. Dangote is carrying almost, you can see, almost 521. It even increased. It was almost 600 in Q1. Now, in end of 2023, it was 521. Q1 2024, 600. It even increased. Meaning by the time you factor the recent one again, it's also going to increase. Now, look at finance cost. Yes. So this is end of 2023. Now, look at finance cost. 191. 191 here. Now, look at the operating profits. 72. So even finance cost alone is far higher than operating earnings. The finance cost of 201 billion is higher. So if we go by earnings before interest and tax divided by interest expenses, so we'll do 72.6 divided by 191.1. Can you see? 0.3. That means Dangote Sugar is not earning enough to cover up its interest expenses. Dangote Sugar is not earning enough to cover up its interest expenses. So whatever amount they are looking to raise via commercial paper right now, it's like robbing Peter to pay Paul. Yes, it might go fine with them. They will successfully do it, right? They would take the money, pay you, pay your interest. Now, what are they going to do? They are going to carry more debt in their book. Now, the next period again, they're also going to do the same thing. So it's a problem right now. So let me check something. Dangote Sugar commercial paper. Look at this here. Can you see Dangote Sugar? Look at this business day. Dangote Sugar taps commercial paper for 50 billion naira. Now, Dangote Sugar has commenced the offering of Series 1 commercial paper up to 50 billion. The offering will open February 22, scheduled to close, blah, 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 and all that. So let's see if we can find the interest return on this commercial paper. The Series 1 okay, here. This webinar is not designed for commercial paper, but I just want to show you something right here. Can you see? I just want to stress this warning here. Buy commercial paper of company with stable outlook and low debt. Now, does it mean Dangote Sugar is not stable or doesn't have, well, for me personally, I would not buy Dangote Sugar commercial paper. That's the truth. I will not buy it. Now, because of the nature of their business, yes, definitely they will continue to be in business. Sugar is considered essential. But then I don't like the risk that I'm seeing on their book right now because assets to liability is almost insignificant because over 98% of their assets are already. So meaning if they have to liquidate their assets automatically, but then they pay up liability, nothing is left for you again. Number two, the earnings of 72 cannot even cover, just from what you're seeing here, the earnings of 72 cannot even cover the finance costs, the net finance cost. And that's also a huge risk. So whatever they are raising right now, I think they're actually using it to shock short-term needs. But there's a problem somewhere. So you need to note this part. So that is my own take on. So you don't buy commercial paper of any company because you want to build a stable portfolio. Make sure you buy commercial paper of stable companies, commercial paper of companies that can generate enough cash flow to pay up their short-term obligation. So that is my take on commercial paper. So when they tell you commercial paper is risk-free, be careful. When they tell you it's a fixed income asset, be careful. Now, even though we've had no record of defaults at all, and then there will always be a way to pay back. But then I also need to do my own due diligence. So that's where your own due diligence come in. Yes, a lot of advisors would have done their own work, they have done their own check, and they feel like, okay, they can pay back the money. But then what I'm seeing in their book it's not quite attractive, it's not quite convincing for me. That is where your own due diligence come in. But then commercial paper is also good. If you buy into a stable company, why not? Your cash flow is also coming in. So that's the two local assets I'm recommending for passive income. Now, let's move to the next one. Now, high dividend stock, high yielding dividend stock or ETF. This is a combination of both local and foreign. So these are companies that have consistently increase their sales, profit, and cash flow in the last 10 years. If you're going to buy into any dividend stock, don't limit yourself to just 1 year or 2 years. Look at the financial result, look at the papers, look at the numbers in the last 10 years. Because you're going to invest for a long time, you want to be sure that the company has been paying dividend for a long time too. So I prefer a combination of local and international dividend stock, printing yields above 11% and 6% respectively. That means if I'm going to buy a local stocks in Nigeria, dividend yield must not be less than 10%. But anything 11% perfect, meaning if I'm going to add multiple dividend stocks together, average yield should be above 11%. Then for the foreign market, 6% is fine. Now, why am I settling for a lower percentage return in the foreign market? Because I have another advantage, and that is what? Exchange rate gain. So 6% dividend yield in Nigeria in US market is actually better than 10% dividend yield in Nigerian market. What is going to give you that advantage is exchange rates. If you are bought a 6% dividend stock in the last 5 years or 10 years, and you have bought a 10% dividend stock in the last, by the time you compound both return down to 2024 and you factor in exchange rate gain, it's not going to be anywhere close to the international dividend stock. So that's why I think 6% is okay for me. Now, in our community, I've also recommended, I recently invested in a US listed bank that have been paying dividend for 19 years plus with double-digit yield above 10% and solid financials. If you're joining our community, this is the type of dividend stock that I recommend. No, I don't limit myself to just Nigerian market. I take myself to the US market because I feel consistency in dividend payment, especially when it comes in USD, we put you as an advantage. Remember, our essence of passive income is to also help us beat inflation. Our essence of passive income should also help us should also protect us from currency risk. This is an example of a dividend stock that will help you hedge against inflation and also protect you from currency risk. When you buy a US listed dividend stock that has almost 10% yield, imagine 10% yield in the US market, and these guys have been paying dividend for 19 years. And then they have good and solid financials. That is the type of dividend stock you should be buying in the US market. So in the Nigerian market too, there are good dividend stocks. Zenith Bank has been one of the best dividend stock in the market. Access Bank has been one of the best dividend stock in the market. ETB. So as long as the yield, it's not about the name or the brand. Make sure you're buying them at the right time. So I like to buy them when the dividend yield is around 10% above, because that way I'll be able to generate good compound return, and I'm also able to beat inflation in the next 3 to 5 years. So when you are investing in dividend stock, don't limit yourself to just any dividend stock, or don't just buy any dividend stock. Make sure you select the best. Less is more in the market. If you own 3 or 4 good dividend stocks printing yield above 11%, you are better off than that person that is buying random dividend stocks. So if today someone is coming to say, oh, I just got my dividends from this, don't feel that you're not doing the right thing. Make sure you buy few and best dividend stock with yield. What is more important is your return on investment. Very key. And then if you're collecting cash in the US market too, and also you're collecting here in Nigeria, perfect. So the overall end point of this passive income asset is not just to collect cash flow, but also to hedge against currency risk and also make sure that you are well off in the long run. So dividend stocks are key. You can't do without them, because here we're looking at passive income assets. When you put your money there, they are the one doing the job for you. The MD is there, the manager is there, the bank is there, the staff is there, everybody is there. You are just here waiting for dividend at the end of the year. So that's what we call passive income. You don't need to be part of the bank. You don't need to be part of the company. You don't need to be physically involved in the daily operation. You have put your money at work, and then you go sit down and let your money generate more returns for you. So there are good dividend stocks in Nigerian market. There are good dividend stocks in the US market. So, well, your job is to make sure you find them, you hold them. Now, not just dividend stock. I talked about stability. You know, when you buy dividend stock because yield is high, you are actually going to put yourself in trouble because a higher yield in the market might be a result of falling price. You know, one funny thing about dividend stock is that when a dividend stock is going down because of a problem, when the price of a dividend stock is going down, yield will start going up. Now, you need to know why the price of that stock is going down. Is it going down because it's an issue? Is it going down because of the market's condition? So if it's going down because of market condition and the company financial is okay, it's just a matter of time. It will bounce back. And that's the kind of dividend stock I want to buy. So if you want to learn more about dividend stocks in the market, the best dividend stock we are buying both in Nigeria and US markets, join our community. Our community is globfolio.com. When you go to globfolio.com right here, you can just click on join the community and then sign in. Once you sign in, you can subscribe. It's already integrated with Paystack, so everything is automated. Then you are in. Please, anytime you join our community, always reach out to me so that I can add you to our WhatsApp. We also have a mobile app, Globfolio app. On Globfolio app, we are working to make sure that every box are fixed. This is our Portfolio app on Play Store. We're working to make sure that every box are fixed so that our conversation will be moved from WhatsApp to the mobile app. So here is dividend stock as another third passive income asset you can leverage on. Now, more on dividend stock too. You can actually invest on dividend ETF. ETF are exchange traded funds. Now you can buy dividend ETF. These are funds that buys US denominated investment grade corporate bond maturing between 1 and 5 years. Now, the same way you invest in treasury bill here in Nigeria, you can also invest in collection of US government bond too, or corporate bond. So there are companies that are doing that already. So what they do is they will buy into corporate bonds, they will buy into US government bonds. They tell you bonds that are maturing between 1 to 5 years. And you know what happens? They collect their interest every now and then. And when they collect interest, they pay you dividend regularly. So this ETF pays dividend regularly. Some even pay you monthly, quarterly, hence providing steady cash flow for reinvestment and personal needs. Now, remember, this dividend is coming in USD too. So yield hovers around 5 to 7%. Okay, let me give you an example. I said I was going to share this with you. A good example of a good dividend paying ETF is iShare floating rate bond. Now, iShare floating rate bond currently yields around 5.86%. Remember, you might look at this money and say, is this not small? But note, you are leveraging exchange rate appreciation in the long term, depreciation in the long term. You're also leveraging the fact that it's coming in USD. And like I said, regular investment in this asset on a monthly basis. Do you understand? That's the idea. Keep investing, keep building, keep buying, keep buying, keep buying. These guys are like your local mutual fund. Now, these mutual funds, what they do is they invest in commercial paper, they invest in treasury bill. Now, at the end of the year, they collect interest, right? So here you are investing in corporate bonds. So because you cannot participate directly in the US market, you are now buying ETF. ETF are exchange traded funds. That means these guys have bought all the corporate bonds. They now broke it into pieces. So you are investing in them. Now, one good thing about this ETF is that it has not lost since its inception. When you look at the performance of this ETF in the from all time since it was approved, 5 years, 1 year, 6 months, 3 months, it's been performing. That means it's been ingrained, it's been going up. So that's the good thing about this bond because they are investing in risk-free assets. That's the kind of investment people want to buy. You know, even when the US Fed was increasing interest rates, a lot of people were flocking to this type of bond because yield were very, very high. So when you want to invest in the US market and you're looking to be stable portfolio, consider investing in dividend ETF like this FLOC. Look at the yield and they pay dividend regularly. How does dividend come in regularly? Because this corporate bonds, they also earn interest. So the interest they are collecting from different assets, different bonds, different corporate bonds will automatically make up their income and then they will distribute to you as a shareholder in the company. So that's dividend. Now, the other one I want to talk about is quite interesting. It's not complete. All these passive income recommendations, they are not complete until real estate. So, I think last 2 weeks or thereabout, I had a webinar with my team, my community members, on how to earn rental income in USD from overseas property. This particular meeting is a paid course on my platform. So, in the comment section, I'm going to post the link there. If you want to buy the course, go to coachoge.com. I'm going to post it there as a course. In this particular webinar, I taught them how to be a co-owner, how to co-own US properties. I taught them how to co-own US properties. And there you will learn a lot on how to invest in real estate. So I want to stop this section right here and then maybe give you time to watch and go over this video. The part two of this video will be coming out shortly. So if this is the first time you're watching this video, make sure you subscribe, turn on the notification bell. In the part two section, I'm going to talk about investing in real estate and also the final assets you need to own. So here we talked about number one, we talked about the treasury bill, savings bond. Number two, we talk about the commercial paper. Number three, we talk about high yield dividend stock. So in the part two section of this course, we're going to talk about the next two that you need to invest in.